Okay, everyone, we're going to start this session now. Welcome everyone to How to Sell New Comparability Plans, a guide on what to look for, what works, and alternatives. This session is going to be designed for people who have had some difficulty recognizing what a new comparability plan is, how it works, and what are some of the guidelines to use in making a decision as to whether new comparability is the way to go. We will have PDF copies of this session available upon request, but I do remind you that this session will also be available in recorded format on our website, www.expertplanexpertviews.com. For those of you who are looking for CPE credits, you will need a couple of code words to email back to me directly. The first of those code words is going to be October. The last code word will be given at the end of the session. After completing this session, you'll be able to understand what new comparability plans are and how they work. A number of times I have come across a situation where people think that new comparability plans are the catch-all for everything, and don't understand when a TPA advisor comes back and says new comparability isn't going to work in this situation. You'll be able to determine which prospects are good candidates for new comparability plans, and determine alternative designs and supplemental designs to create an effective tax deduction program. And this session is designed for practitioners who have a basic knowledge of pension plans. I encourage you folks to jot down any questions you might have. We will not be entertaining questions during the session because it is being recorded. However, at the end of the session, I will open up the mic and offer any questions and answers that you might have. So to start with, you need to know what is a new comparability plan. Some of you already know, some of you don't. But I have found that many people do not understand what they are, so let's see where we begin. When ERISA first came out in 1974, it had a section code called 401A4, which simply said you can't discriminate in favor of highly compensated individuals. I believe it was 2 lines of code, and that's all it stated, and never clearly defined what that meant. A highly compensated employee is clearly defined. It's defined as either a 5% owner and their spouse. We do include lineal ascendants and descendants to that 5% owner. And any employee who earned $115,000 in the prior year. Now it's important to note that prior year definition, because somebody could be earning $150,000 in the current year, but if they earned less than $115,000 in the prior year, they are not considered highly compensated employees. New comparability plans have been around for a while now, and they're also known as cross-tested plans. Some of you may have also heard them as age-weighted plans, but age-weighted plans are basically a subcategory of new comparability plans, which are more limited than the general new comparability plan that we'll be describing today. Well, the IRS decided many years ago, about 12-15 years ago, to expand the definition of what does it mean that you can't discriminate in favor of highly compensated individuals. So they issued final regulations in 2002 and took 2 lines of original code and turned it into 300+ pages of code. Those 300+ pages were designed to provide a definitive methodology for satisfying non-discrimination. They provided tables and calculations to provide that definitive definition, but opened up the door tremendously to a lot of flexibility in pension design. That 300 plus pages of code recognized that defined benefit plans and defined contribution plans had different characteristics, and because they have different characteristics, they needed separate testing guidelines. And they opened the door of creativity by permitting cross-testing. By cross-testing, we're saying that defined benefit plans were permitted to use defined contribution testing, but more importantly, defined contribution plans were permitted to use defined benefit testing to satisfy non-discrimination. Age now became a very important criteria. Now you may be asking yourselves, why are we even learning this aspect of it in how to sell new comparability plans? Well, if you don't understand the product that you're selling and how it's coming about and why it works, you're not going to be able to sell it effectively. This session is not designed to make you a good TPA or administrator. This session is designed to basically give you an introduction as to what new comparability plans are, some of the things that are incorporated in new comparability plans, and the reason why some plans work and some plans do not. Know the rules. If you know the rules, you'll be able to be a more effective salesperson and be able to sell these plans much more effectively than you could otherwise. Now, as we stated, 401A4, 300 plus pages of code, introduce definitive methodologies on how to prove whether you're satisfying non-discrimination or not. Well, those methodologies are essentially required tests. New comparability must satisfy 3 different tests in order to pass non-discrimination. You have to satisfy a gateway test. That gateway test is probably the one factor that's going to be more limiting than any other test that you may come across, but not always. An average benefits test. The limitation of the average benefits test is that you must include 401k contributions in this one test, and sometimes that can end up being a disadvantage to you. And a rate group test. We are not going to get into what each of these tests are and how they work. We're just trying to make you aware of the fact that there are 3 different tests, and because of those 3 different tests, again, not all plans will meet the requirements necessary to satisfy new comparability. I also want to note that this session is going to be heavily incorporating a number of examples so that you can essentially look at which example satisfies your particular client or prospect's needs. And in particular, it's going to have a flow chart which I think all of you will enjoy having, because it's going to give you real good guidelines of when you can or can't use new comparability plans. So again, in determining whether your prospect is a candidate for new comparability requires a basic knowledge of these tests. All 3 of them require minimum benefit levels. Average benefits, as noted, includes 401k. An average benefit test and rate group test are based on age, compensation, and benefit level. So the questions you need to ask and to make an appropriate determination on whether your prospect or client is an appropriate new comp candidate, you start by what size group is appropriate, what age mix is appropriate for a new comparability plan, what minimum earned income must the owners be making, and does the structure of the business entity matter, sole proprietor versus corporation. the illustration requests that we get numerous times do not fit new comparability because of various issues associated with each of these questions, and we will get into some sample designs that'll illustrate what we're talking about. So what size group is appropriate? Well, let's start with the smallest one, an owner with one employee. You have an owner who's earning $250,000 or more, and we're going to assume for this example that we have an optimal age difference, and the owner wants his maximum benefit. Okay, if you have one employee who earns $15,000 or less, remember you have these three tests. Well, the one test, called the gateway test, is probably going to require a 5% minimum contribution for this one employee. That's going to mandate a $750 contribution. You'll have administrative costs, which will be relatively high for a two-man group, but that's because of the testing involved. And you need to ask yourself the question, hey, I've got a small group here. What about a SEP, or a Simplified Employee Pension Plan? Will a SEP work better than new comparability because a SEP requires no administrative costs at all? The benefit of new comp when you have one employee with less than $15,000 is negligible because the cost-benefit analysis is negligible. But conversely, you will find that even with a two-life group, new comp will work well if the employee, the non-owner, is earning over $15,000 and the age difference is optimal, which we will discuss later. So similarly, if the owner is earning $150,000 or less, requires SEP contribution of 33.33%, and the lower the owner's compensation, the higher the SEP required contribution, and the more likely new comp will work better than any other option. Well, let's take the opposite. Let's say we got an owner with 15 employees, and the owner wants to target his maximum $50,000 benefit. Gateway test again will likely mandate a 5% contribution to the rank and file. If the rank and file are making $50,000 each, those 15 employees are going to have a payroll of $750,000, and that 5% mandated contribution is going to total $37,500. So when you compare, the owner gets $50,000, he's got to give up at a minimum $37,500. That's not a tax effective situation. Conclusion, assuming optimal age difference, the lower the rank and file payroll total, the more likely new comp will work. Rank and file payroll under $400,000 total could be a good new comp candidate. So there's your first criteria. You're talking to a prospect. That prospect is giving you a census to look at, and you have determined that rank and file total payroll is under $400,000. You move on to your next criteria to see, hey, so far it looks like new comp may work. I can't tell you the number of times I have gotten a request for a new comp illustration with one owner, 50, 60 employees, and they do not understand why I come back and say there's no way that this is ever going to work in a new comp scenario with a tax effective program because there's too many employees. They've heard that age difference being optimal, new comp always works. That's not always the case. You need to have a good average number of rank and file employees and rank and file payroll versus the payroll of the owner or owners. So for example, we have an owner who's age 50 and earned income of over $250,000. He's in a 40% tax bracket, and he's got one employee age 30 earning $15,000. Under a SEP, the non-administrative cost option, the owner wants $50,000 or 20% of pay. With a SEP, the employee must also get 20% of pay or $3,000. There's no administrative costs. In a 40% tax bracket, this owner is saving $21,200, and it costs him $3,000 to his rank and file employee. Under the new comp option, the owner still gets $50,000, but now the employee is only getting 5% of pay, which is the gateway minimum, or $750. But now we're introducing a cost of administration, or $1,800, plus any implementation costs. Total tax savings is very similar, $21,000 plus, and the cost to the owner is the $750 plus $1,800, or $2,550 plus implementation costs. I consider this a virtual break-even point. There is slight cost savings to the new comp, but less work and more employee appreciation under the SEP. This is where I would say that you probably would lean towards the SEP option, even though you could save a little money under the new comp, simply because it's easier and easier to explain, plus you're benefiting your employee better. Second example, Company B, same owner earning $250,000, but this one employee, same employee, is now earning $50,000. Under the SEP option, that employee needs to get 20% of pay, or $10,000. There's no administrative costs. The tax savings are up to $24,000 because the total expenditure is $60,000. The cost to the owner is the $10,000 contribution to the rank and file employee, and he has a net savings between the tax savings and his cost to the employee of $14,000. Under the new comp option, the owner is still getting his $50,000, but the cost to the employee is now only $2,500. Cost of administration is $1,800 plus implementation costs. Tax savings go down because there's less expenditure here, and so there's less tax savings. But the cost has gone down dramatically, from $10,000 down to $4,300, and the net savings after tax is $17,420. Demonstrating that even in a two-life group, and I can't emphasize this enough, even a two-life group, when the rank and file payroll increases, cost savings under new comp can become dramatic. Even recognizing administrative costs, the employer is saving $3,420 over a SEP plan. Many, many times you will find the accountants will be putting in a SEP because it's simple and easy to administer, and you will have an opportunity to walk in and introduce the new comp option and demonstrate tax savings, which would be quite substantial, and pull them out of the SEP option and into the full-blown new comp option. Company C, same owner earning $250,000, but now 15 employees aged 25 to 60. Average age is 30 and average earned income is $50,000. Now instead of a SEP, we're going to be dealing with a simple plan that has no administrative costs. For those of you who don't know, a simple plan is essentially a 401k plan, but with no administrative costs and with certain limitations in contributions that are lower than a 401k plan. Owner is deferring his maximum $14,000, which is the maximum under the simple plan, and is receiving a 3% match or $7,500. All employees are deferring their 3% in order to get the 3% match, or $22,500 total. No administrative costs. The tax savings of what the employer is spending is $17,600. It's costing him $22,500 in employer match costs to the rank and file. And he's actually losing money under this scenario to the tune of $4,900. Under the Safe Harbor 401k option, which is again a step up from simple but not introducing new comp, the owner can defer more. The owner can defer $22,500. He's getting a higher match, but in a worst case scenario, it's costing him more on the match to his employees to the tune of $30,000. Cost of administration is now being introduced, and comparing the tax savings of $25,800 against the cost factor of $32,000, and the employer is losing money again to the tune of $6,200. Introduce new comp with a 401k option. The owner's benefit now goes up to the full $55,500. It's costing him $37,500 to his employees. Introduce higher cost of administration due to the testing involved in new comp. And the tax savings of $38,230 versus the cost of $40,000 still puts the owner in a negative position, but the negative position is much lower than the other two options, and more money is going in for them. The net answer is, when rank and file payroll increases, we talked about this before, compared to the compensation of the owner, it becomes less and less likely that an effective tax program can be generated. In this situation, new comp is a better option, but it's still not tax effective. So again, I emphasize the fact that you have to look at the total payroll of rank and file as an average per owner, and if that total payroll per rank and file goes up, it doesn't matter what your age factors are, you are not going to get an effective tax program. Lastly, Company D. Same scenario, but we have two owners, age 50 and 55. Going fairly quickly through, we're going to see that the fact that we now have two owners splits the cost per owner of the payroll, and we now have an effective tax program under new comp because we have cut the payroll per owner in half, and by cutting payroll in half, we are able to generate a net tax savings under the new comp program of $20,000, and we have a very effective tax program. So the mere fact that we may have a larger group does not mean that you should ignore new comp or any pension option or alternative, because we still may have the option to introduce new comp if we have more than one owner and the owners are splitting the net cost to the rank and file employees. So always measure rank and file payroll as an average against the number of owners or targeted employees. So remember, going back, that was our first question. What payroll mix or compensation mix is appropriate? We're now on to what age mix is appropriate. What works when we're talking about age? So we start with an owner who's age 50, but every one of his employees are also age 50 or older. Now the problem isn't with the gateway test. The problem is with rate group and average benefits test. These two tests require some age discrepancy, with the older owner being older to pass. Remember what the whole theory is here. These are cross-tested plans. These are plans that are being tested as if they're defined benefit plans. To get appropriate tax effectiveness, we cannot have the owner the youngest employee of the entire group. Again, I can't tell you how many times I've had requests for illustration where the rank and file, every one of them were older than the owner, and I come back and say, sorry, this is not going to work for new comp, and being told why not. Well, now you know why. Because test 2 and test 3 require some age discrepancy. We have to have that age appropriateness to make new comp work. So what happens if 25% of the employees are in their 20s, but the rest are still age 50 and older? Well, the average benefits test may pass, but rate group, because remember there's 3 tests here, may or may not pass. The easiest and the only answer I can give you there is that new comp may or may not work. The younger the 25% group, the better. But there's other factors that come into play, and in that situation I would offer up that you still get a census, you still look it over and see if it does work. But lastly, if 50% of the more of the owners are 5 or more years younger than the owner, new comp will likely work. Now notice, I'm not saying that every employee needs to be younger than the owner. I'm simply saying that if you have at least 50% of the workforce younger than the owner, and those employees are at least 5 years younger, you might have a good case for new comparability in that situation. And please keep in mind, everyone on this session, I'm not trying to make you third-party administrators. I'm just trying to give you guidelines for what to look for when you walk into your prospect and say, hey, look, will or do you have a better alternative than what you have now, and can I give you a tax-effective program? You need to know what to look for, and these are just guidelines of what to look for. So now, what happens if you have the owner and the owner's spouse is on the payroll? The owner wants to target $50,000 to himself. The spouse is on the payroll with a minimum amount of payroll, and you have that attribution of ownership we talked about in one of the earlier slides. Because of attribution of ownership, it doesn't matter how much that spouse is earning, that spouse is also considered highly compensated. You can use that to your benefit. Have that spouse get no benefit whatsoever, and you could end up splitting payroll, going back again to the prior slides, because now we have 2 owners. You can split payroll and possibly create a far more advantageous situation to you. Why do I mention this? Because many is the time that I'll have that situation 2 on your left, 25% of the employees are in their 20s, and by adding a non-benefiting spouse on payroll with a minimum payroll amount, say $5,000 to $10,000, you now have split your test, and that 25% group might very well qualify for new comparability. These are creative targets that you want to be thinking about. What happens if I add a spouse? If I make that spouse a non-benefiting spouse, do I improve my position? Absolutely. So, new comp requires an appropriate age mix. Having 50% or more of the employees 5 years or younger than the owner is appropriate. And adding a totally non-benefiting spouse or other HCE could lower this to 25%. Some examples. Company A, owner, same guy, earning $250,000 more, 40% tax bracket. But now the employee is age 45, or a 5-year age difference, in earning $50,000. Again, under the SEP option, it's costing the owner $10,000, $24,000 tax savings for a net savings of $14,000. Under the new comp option, the owner has to pay not 5% this time due to gateway, but because we're only dealing with a 5-year age difference, he's got to pay 13.5% of pay to satisfy that third test or rate group test. So obviously the older the bigger the age spread, the better these numbers work. But even with a 5-year age difference, it's now costing him $67.50. The total costs involved are $85.50, and the net savings are $14,870. The whole point of this is that with a 5-year age difference, we're finally crossing into a better program with new comp, and the more that age difference widens, the better the results you're going to get from this. So again, the smaller the age difference, the more likely rate group testing will require higher contributions, and an average age difference of 10 or more is ideal. Second illustration. We now have an age 25 employee. Same results on the SEP side, but now the new comp side, the owner is only age 35 in this example. It's not the same owner. It's an age 35 individual. But there is a 10-year age difference, and with that 10-year age difference, we're now at a 9% pay rate for the employee, or $4,500. Net impact is a net savings of $16,220. And the whole point of this example, and keep this in mind please, is that the owner does not need to be old. It's a relative age difference which is important. In this case, we have an owner who's fairly young, 35 years old, but because there is a 10-year age difference, we are able to create a significant tax savings over the SEP option by using new comp. So don't ignore new comp simply because your owner may be younger, if that owner has even younger yet rank and file employees. So now we have company C, we have an owner age 50, and we have that spouse earning a minimal amount, $10,000. There's an error on here. There should be 5 employees, ages 25, 45, 46, 48, and 52, and earned income is $50,000 as an average. Under the new comp option with the spouse not on the payroll, the employees are earning 15% of pay, or $37,500. Cost of administration is $2,500. Net impact is a loss to the owner of $2,000. Now puts the spouse on payroll but with no benefit, and we split everything up, and look at the dramatic difference of what results. By just putting that spouse on and having no benefit payable to the spouse, we are able to generate a net savings of $11,425, and thus by adding a non-benefiting spouse to payroll, we can dramatically improve the new comp results. So, third category down, we know what age differences we're looking for. We're looking for hopefully 50% or more of the employees being younger than the owner, and preferably that 50% that's younger is at least 10-year age difference, although a 5-year age difference would likely work also. But what does the owner have to be earning? I mean, do they have to be earning $250,000 or the maximum with every illustration? So let's take an owner age 50 who's only earning $150,000. He's got an employee at an optimal age difference because the employee's age 30, earning $30,000. The owner wants to do $50,000. He's satisfying the gateway test at 5%. Rate group and average benefits test passes also because there's such a large age difference. So is this working? Is this a perfect example? And the answer is no. There is a maximum tax deduction limit of 25% of eligible compensation. And this is one of those gotchas that you need to be aware of, that there's always external issues that may come into play, so always be aware of those external issues. And the fact that new comp can work well even with lower compensations, but beware the impact of other laws. That's where your partnership with a TPA comes into play. Your TPA will make sure that you don't get into trouble with these other issues, but just be aware that they may exist. So now let's take an owner age 60 and having 4 employees, each earning $7,000 with an average age of 30. Total compensation is, that should be each employee is earning, the earnings factor is off. Let's just say the total compensation for the employees is $238,000. So you take the total compensation, multiply by 25%, and you have a maximum tax deduction of $59,500. The maximum benefit per individual under 415 is 100% of compensation, or $50,000. The owner can get his $50,000. It's costing him only $9,400 to his employees. He's under the tax deduction limit, and thus new comp works even with an owner as low as $50,000. Now this is an exceptional case here. This is not the norm, but it demonstrates that new comp can work at compensations for the owner as low as $50,000. But the lower the owner compensation, the wider the age disparity that's required between the owner and rank and file for this to work. Lesson here is that the higher the owner compensation, the smaller the age difference can be. The lower the earnings for the owner, the wider the age difference must be. So keep that in mind. And then the last issue that we had on our structure was, does the structure of the business entity matter? Sole proprietor versus corporation. Well, new comp can be used for any business entity, but where people often get into trouble is, what is earned income? Every pension plan is functionally related to earned income and what that earned income is. And differences in business structure will often create differences in what earned income is defined as. A C corporation or a regular corporation, earned income is easy. It's W-2 compensation. For an S corporation, you would still use W-2 compensation, but this is the biggest gotcha that I've seen out there many, many years now, is that we cannot include K-1 income off of an S corporation. That is not considered earned income for pension purposes. So, for example, I've had numerous situations where I've been requested to do an illustration for the owner of an S corporation, and that S corporation owner is drawing payroll income of $60,000, but receiving K1 income from his S Corp of $500,000. And I'm being told, hey, the person's earning $500,000 a year. That is not true for pension purposes. Always ask for the nature of the business entity, and if it is an S Corp, make sure you clearly identify what is payroll income versus K1 income. For a sole proprietor, we use the net Schedule C off of his tax return, minus the 1/2 Social Security tax deduction, minus the pension contribution. Now, that's like a catch-22. The sole proprietor is telling you, hey, I earned on my Schedule C $200,000. What can you do? You got to make sure that if he's targeting $50,000, that you're taking that $200,000, knocking it down by the approximate Social Security deduction, let's say it's $10,000, but also knocking it down by that $50,000 pension contribution, and the net earned income is $140,000 for testing purposes. Going back to those prior slides, that can have a dramatic impact on testing. And partnerships, we are allowed to use K1 income off of a partnership or an LLC that's being taxed as a partnership, and the result is similar to a sole proprietorship. We use the K1 income minus the 1/2 Social Security tax deduction minus the pension deduction. And again, it's absolutely critical to determine business structure and to be sure of the nature of the owner's income. You don't want to get into trouble by finding out that new comp or whatever proposal you do is not going to work because the earned income is far less than what you originally thought it was. So as an example, owner age 50, one employee age 33 with an earned income of $50,000. Under a C Corp, the owner is getting a W-2 of $250,000. Employees getting 5% of pay. Using new comp, total cost to the employer is $2,500. Under a sole proprietorship, the net Schedule C of $250,000 now gets Jimmy down to $185,000 using those prior definitions. At this level, the employee must get 7% of pay due to the rate group. The total cost to the employer has now gone up from $2,500 to $3,500. So again, always identify the business structure, always question the nature of the income that's provided. And new comp isn't always the answer. What should you be looking for? These are the summaries of what we just went over. Assuming an optimal age difference, the lower the rank and file total payroll, the more likely new comp will work. Rank and file payroll under $400,000 total could be a new comp candidate. New comp requires an appropriate age mix. Having 50% or more of employees 5 years or more younger could be appropriate. Adding a totally non-benefiting spouse or other HCE could lower this to 25%. These summaries are very important, people. This is where you're going to see whether you know or understand whether new comp works or whether it doesn't work. And new comp can work at reduced compensations, but the lower the owner compensation, the wider the age disparity required. So now, you're a salesman. You're walking in the door, you have a prospect, and where do you start? First question is, do you have a pension plan? Do you have one currently in place? If yes, is it a SEP? If it is a SEP and you have a SEP in place, have you made any contributions for the current year? A simple? Well, if you have a simple in place right now, your answer is real simple for right now. You can't put another pension plan in place if your prospect has a simple already in place for the current year. You can replace the simple for the future years but you cannot do anything for right now. Or is it a traditional plan? If it's traditional, is it 401k? Is it safe harbor? And now we're going to go to our flow chart, and this is where all you have to do is run your fingers along and you can see what your answers are. So again, does your client currently have a pension plan? If it's yes, what type of plan? And look and note what some of the answers are. If you have a SEP, has a contribution been made for the current year? If yes, your client is prohibited from putting in any other plan for the current year. If no, your client is free to put in any plan which better meets their objective. It's as if they had no plan at all. If they have a simple plan in place, the client is prohibited from putting in any other plan for the current year. And just as importantly, look at your watch, guys, it's October 12th. If your prospect has a simple plan, that plan must be terminated by November 1st to be eliminated for the following plan year. Now, if you have a traditional plan, is it a 401k plan? Yes. Is it a safe harbor plan? Yes. More often than not, that safe harbor plan cannot be modified to new comp for the current year unless the safe harbor is removed. If it's no, the plan document itself may restrict changes and needs to be reviewed. If it's not a 401k plan, your plan document again may restrict changes and needs to be reviewed. If it's a profit sharing, if it's a defined benefit, your client is free to put in any plan which better meets their objectives. I think this is an easy flow chart to use, and will give you some guidance for any plan or prospect that you may be walking in on. So now you've determined your prospect does not have a plan, or the prospect has a plan which can be modified per the prior flow chart. What's next? Does your prospect have any rank and file employees? And the big caveat there is just beware of controlled group issues. Make sure that your owner doesn't own any other companies. If they do, don't try to be a hero and figure out what's going on. Go to a professional and find out what the impact is of those other companies. What benefit level does your client or prospect want? Is flexibility important? What about their future cash flow needs? Let's say they have a huge need for a large deduction this year, but they don't know what they're going to do next year. Finding out what those future needs are almost as important as what the current needs are. And we go to flowchart page 2. So, do you have rank and file employees? If the answer is no, I will tell you right now, new comp is not the way to go. If you have no rank and file employees, you want to consider either a SEP with no administrative costs, a solo K which will give you a little bit more benefit allowance, or a defined benefit plan if you want to really blow the numbers through the roof. I'm selling a lot of defined benefit plans these days for clients that have no rank and file employees and need a deduction bigger than $50,000. If you do have rank and file employees, and the answer is yes, what's the benefit level that are desired? If you need to do more than $50,000 or $55,000, you want to try a new comp plan with cash balance options. That option is beyond the scope of this session. We do have webinar sessions that you can either attend. I believe we also have them online, which discusses cash balance plans. I do encourage you to learn what cash balance plans are and how they work. They're extremely popular today and in high demand. But let's assume that what your prospect or client is looking for is a benefit level that's $55,000 or less. Use the rules you just learned. Is the rank and file payroll under $400,000? No, you want to go to other options such as safe harbor match or pro rata or integrated profit sharing. If it's yes, do half or more of the employees, are they at least 5 years younger than the owner? What's the possibility of adding a non-benefiting spouse? If it's yes, does the owner have significant earnings? If yes, you have an ideal new comp candidate, and you will be astonished how many times this flowchart is going to lead you down to the new comp option. Most times in the small business sector, you're going to find an owner that's earning a lot of money, maybe has a limited plan or no plan at all and wants to introduce, but needs a lot of flexibility. You don't do any better than new comp, and most of these options generally will hold true, although not always, which is why this flowchart should be followed so that you don't make a mistake in introducing something that may not be appropriate. So what's next? Absolutely get a census. Suppose you suspect that new comp is the way to go. This is what you want to sell. The client has indicated a desire to do it, and everything seems to be falling in line. Get a census and get an illustration done. Make sure you know what your owner or targeted employee's objectives are. Is it flexibility? How much towards the $55,000? If it's less than $55,000, what is the maximum that they're trying to achieve? And check all ownership and prior year compensations. Why? Remember, one of those first slides described what a highly compensated employee is. That highly compensated employee definition is based upon ownership, and it's based upon prior year compensations. And don't forget to attribute ownership to spouses or lineal ascendants or descendants. By doing so, you're going to establish who's highly compensated and who's not highly compensated. Determine who's eligible to be in the plan. For instance, if you have a number of people who are employed but working less than 1,000 hours per year, make sure you note that. There are chances that you'll be able to exclude a lot of those employees. And get a qualified TPA involved. Get an illustration. Let them do the calculations. You've identified your prospect as being a new comp candidate. Do this information, get the census, determine objectives, check ownership and prior year compensations, and then get a TPA involved. That TPA should be able to get you an illustration which is going to help you make your sale. So it starts with a plan strategically designed. Gather census. Upon receipt of the census, get a qualified TPA involved. Get sample illustrations based upon desired objectives. And just as importantly, make sure you set up a conference call. Go over the findings of that TPA. Have that TPA explain what's going on and why they chose the illustration they did. Maybe modify the illustrations to better meet the needs. And oftentimes, get the client on the phone. Let them describe what their needs are after seeing what your illustration has produced. Generally, plans can be set up quickly when needed, but you should try to allow 4 to 6 weeks if possible. Generally, at this time of year, that gets to be hard to do. So if you need it faster, most TPAs can get it done faster. Again, though, if you want to be setting up a plan or changing a plan in a comfortable scenario, try to allow 4 to 6 weeks. And if you need a proposal from us, we need census data, and you can always contact us at the information that you're seeing there. Make sure your census data includes a name. It doesn't have to be an actual name. It can be some facsimile. But critical, is date of birth and date of hire. Try to get hours if possible, and compensation is obviously critical for some of the reasons we already described. Identify any and all family relationships that are associated with the owner. And for better projections, identify anyone who's preferred other than the owner. Many times there's a manager or somebody that the owner wants to benefit a little bit more. Make sure you provide details on any existing plans. Many of the time I've been requested to do an illustration when the client has a simple plan in place and the illustration is for nothing because the simple cannot be replaced midstream. So make sure you get details on existing plans. And if possible, see if you can find out what the anticipated 401k deferrals are for everyone. That one is the hardest one and not really necessary, but ideal if you can get it. And contact us at the addresses that are noted. Any of those will work, and we would be happy to provide you an illustration. At this time,